Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Monday, 13th October. Coming up on the show, US stocks are set to rebound after Trump changes his tune on China. Big banks will take centre stage this week as they kick off another earnings season. And we'll tell you why Bitcoin is no gold. So grab your coffee and let's own the morning. Well, the first thing you need to know is that President Trump seems to have backtracked on his threats towards China. He posted a statement on Sunday that hinted at a possible de-escalation of trade tensions between the US and China, while at the same time issuing a veiled threat to China's President Xi Jinping. Remember, Trump ratcheted up tariff and trade tensions with Beijing on Friday in a post on Truth Social. The president said the US would impose an additional 100% tariff on Chinese goods starting on November 1st. The next thing you need to know is how this is all impacting on the stock market. Well, US stock futures are surging before the opening bell this morning and look set to bounce back strongly from Friday's rout. That positivity seems to have spilled over to Europe, where markets have opened on the front foot as well. But Asian stocks fell heavily. Economies in the region are most exposed to trade and China uncertainties compared to the rest of the world. Beijing criticised Trump's initial plan to impose additional tariffs and threatened countermeasures. Chinese stocks fell despite stellar trade data that showed that whilst exports climbed at their fastest pace in 6 months in September. And the final thing you need to know is that investors continue to flock to safe haven assets. Both gold and silver prices surged following President Trump's threat towards China, and they both continue to rise today. Gold hit another record high. It's up over 50% this year, driven by demand for safe haven assets, expectations of lower US interest rates, and continuing central bank buying. Silver is up even more this year, and futures hit an all-time high. Gains are being supported by a combination of strong investment demand, tighter supply conditions, and a short squeeze in London markets. Well, if that isn't enough information for investors to deal with, another earnings season kicks off this week. My colleague Josh Lipton is here with what you need to watch this week.
Time now for what to watch. Starting off on the earnings front, it's that time of year again. That's right, we're talking about earnings season. A lot of reports coming up. Big banks will be kicking us off, including JP Morgan, Goldman Sachs, Citi, Bank of America. JP Morgan announced results for the third quarter on Tuesday. Analysts expecting the largest U.S. bank by market cap to post strong Q3 results, driven by trading and wealth management. But it's also facing higher costs and upcoming rule changes that could shape its 2026 outlook. Taking a look at the Federal Reserve, we're going to be getting a close eye on upcoming commentary from multiple Fed officials. This is coming after some comments from Fed Governor Michael Barr on Thursday. Barr calling for a cautious approach toward further interest rate cuts, emphasizing the possibility that tariffs could create persistent inflation. And taking a look at Washington, looks like that government shutdown is dragging into another week. The Bureau of Labor Statistics saying it will publish the September Consumer Price Index on October 24th. The data was originally scheduled for October 15th. The delay potentially impacting the Social Security Administration's ability to calculate the cost of living adjustment, often referred to as COLA, for the following year's benefits.
Well, let's get more on how the president has moved markets across the globe with our guest Russ Mould, Investment Director at AJ Bell. Russ, great to have you here on Market Sunrise.
Thank you.
Well,
thank you, Ramzan.
What do you make of all the social media statements from the president? How do investors navigate all of this?
They're probably better off trying not to bother, but I guess they probably can't help themselves, given that we've, again, had a situation where there was one fairly strong statement made one day and a slightly less strong statement made the next day, with the result, one big wobble, one big rally. And I think net markets are still hoping, longing for, anticipating that President Xi and President Trump meet in Asia towards the end of this month, possibly at the annual economic summit that's due in Korea this year.
But this taco trade that was coined earlier this year, Trump always chickens out, is he this time as well?
I was trying not to use that word. That seems to be the perception, that there was a strong statement, a market sell-off, a backtrack, a market rally. It's a pretty similar pattern to what we saw back in spring, yes.
Now, one of the sectors that was most affected by Friday's sell-off was tech, and in particular any stock related to AI. What does this tell us about this AI bubble that people seem to be speculating more and more about?
Well, I think even more widely than that, we've seen there was a big rout in a lot of second-tier cryptocurrencies last Friday, and then a rally in some of the bigger names. You've seen a lot of consternation and worry on social media about heavy losses. Is the market turning? And in the end, we had a one down day, a 2% fall in equities, and you've seen an awful lot of worry. So it does make you wonder about just exactly who's got how much margin in their account, who's levered up where, because it does not just magnify profits, it does magnify losses when things go wrong. So it does make you worry a little bit about the wider market architecture. Richard Buxtaber's book, Demons of Our Own Design, always talks about leverage, opacity, and complexity as the prerequisites for any major correction. Well, you can argue they're all in position right now, not just in AI, but perhaps more widely, looking at how much margin account activity you can see on the FINRA data. It's just crossed a record level of $1 trillion US.
Oil prices are also on the rise today as Trump is in the Middle East, as Israel and Hamas look set to sign a peace deal in Egypt today. Is the rise more down to what's going on between the US and China rather than what's going on in the Middle East?
And again, oil took a massive thumping at the end of last week because of fears of what possibly increased tensions between the US and China, where that could go and what that could do to global economic growth. So again, it's probably a bit of a sort of automatic reaction to soothing, more calming noises. Overall, the tone on oil still seems relatively bearish, with a price down on Brent in the low 60s and WTI in the high 50s. OPEC's gradually sneaking demand up. The IEA is gradually sneaking its demand forecast down. I guess you can say one thing is that a lower oil price is A, something that President Trump wants to see. B, is potentially quite helpful for consumers and corporations, and it puts a bit of a lid on inflation. So it's probably not the worst thing in the world.
And I mentioned it's a busy week for earnings. We've got all the big US banks on deck. What are you expected to hear from them all?
I think on the face of it, the numbers should be pretty benign. Again, if you've seen an improvement in loan and in deposit growth, you've seen net interest margins come in relatively stable at decent levels, and loan impairments have been relatively subdued. So I think they're the trends that analysts and shareholders will be looking for. If there is any upset there, it's likely to be in loan impairments, just because what we've been seeing at First Brands, Tricolour and others. JP Morgan, Chase, just one name bandied around with regard to possible Tricolour losses. Be intriguing to see if that does start to come through on the impairment line.
Russ Mould from AJ Bell, many thanks for your thoughts.
Thank you.
Okay, it's now time for a short break, but stick with us. Our markets and data editor, Jared Blickery, has the latest episode of Stocks in Translation. Welcome back to Market Sunrise. Well, investors are gearing themselves up for the fourth year of a bull market. Well, Jared Blickery took a closer look at some of the biggest movers over the last 3 years and highlights some of the conditions to take into consideration on Stocks in Translation.
3 years ago, the 2022 bear market bottomed. And as year 4 of this bull market kicks off, investors want to know how much room we have to run. And that's what we're focusing on in today's Stocks in Translation. This first chart here is courtesy of Keith Lerner over at Truist, and is showing every third year of a bull market since 1957. Notice the far right. The current year, year 3, is the strongest of the bunch. So now we've got momentum, but how long do these bull markets typically last? Well, zooming out almost a century, here are the S&P 500 returns for all the 15 bull markets since 1932, including the current one. The bar at the far right is the average of the prior 14, which is almost double the current return of over 85% in the S&P 500. On average, bulls last about 5 years, 2 years longer than the current one. So at least according to history, this is not an old bull market just yet, and there's more theoretical room to run. Now let's see who did the heavy lifting. And for that, we're going to first turn to the S&P 500 sectors. This is going back 3 years, and you can see XLK here is up 139.5%. That is the leader. And if we take a look over the last 3 years, you can see a few hiccups and some sideways action here. And by the way, that's when NVIDIA was also going sideways, but it has really rocketed recently. Number 2, That's communication services. That has Alphabet, and it also has Meta. Then we have industrials, financials, each up more than 70. And then XLY is consumer discretionary, a bunch of retail names with Amazon and Tesla at the lead. Now, if we drill this down to 1 year, you can see a little bit of red. But aside from materials, XLB there, all the red ones are defensive, so this is still bullish in nature. Number one, that's communication services with 26.8%, and then tech, and then consumer discretionary. Those are the mega cap sectors, so there are concerns of concentration right now. Even number four, XLU, that's utilities, up 15.6%. Well, that's kind of an AI derivative play right now. So let's check out the NASDAQ 100. And here we can see in the upper left there's good old NVIDIA, $4 trillion stock, up 40% over the last year. But I'm going to change that to a 3-year look where it rockets higher to 1,523% and change as we're talking here. Here's a quick chart, and you can see there's that sideways action that we were seeing in tech that also corresponded with NVIDIA taking a pause, but again, rocketing higher very recently. But guess what? Palantir up 2,150%. That tops it. And you can see this is just really rocketed up mostly over the last year. We had a lot of green on this chart and not a lot of red. So let me just skip over to some of our leaders where in the upper left, when we take a look at some of these sentiment ETFs, GBTC, that's my Bitcoin proxy, up over 800% over these last 3 years. In second place, we got the chip stocks at 166%, then MEG 7 ETF, then ARK Innovation Fund, then we got software, the Qs, that's basically the NASDAQ 100, an internet ETF, and ITA. ITA is interesting because this was a really good defensive play when we had the post-Liberation Day sell-off. It didn't fall off as much as everyone else, and it's probably still a pretty good diversifier. So putting it all together, we got some good options here. We've had a lot of bullishness, but let's take a look at what to look for in the coming weeks and months as we head into the 4th year of this bull market. So as earnings from big tech come rolling in over the coming weeks, you want to pay attention to the AI leaders, which are currently priced for perfection, as the street says. Any misses, especially on future guidance, that could bite. Then we want to watch out for sector rotation on any pullbacks in tech. Rotation is the lifeblood of bull markets, as they say, and we want to see investors move into other areas besides tech to keep this bull market alive. Then you got to watch gold flows. According to the work of Todd Sohn at Strategas ETF Research, the 1-year flows in gold ETFs have just reached the same level in 2020 that occurred just as the price of gold was topping and starting to turn down. Now, history doesn't have to repeat, but gold ETF flows are red hot. And if the trend reverses, that could hit the price of the yellow metal as well. And now that Bitcoin is back to record highs, watch the crypto bid. Bitcoin is famous for reversing short term after hitting new highs, and a dip below 120,000 would be an orange flag for risk sentiment in general. Finally, meme stocks are surging, albeit for different reasons in 2021, but it's incredibly interesting that Roundhill just relaunched their meme ETF a few days ago, and when they first launched their meme ETF in late 2021, that essentially top-ticked the initial pandemic bull market, and it was the start of the 2022 bear. So putting it all together, this is not an old bull market by historical standards, but it is very speculative lately. Earnings will set the tone soon, so stay alert. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Okay, we're heading for a short break, but we'll be back with trending tickers. And as you can imagine, there are some big moves to watch out for. Plus, why Bitcoin should be dubbed digital gold. It's time now for today's trending tickers. Global trade tensions are sending shockwaves across the markets this morning, and it's not all about Trump. The Netherlands took an unprecedented step against a Chinese company to defend its national security. Chinese chip manufacturer Wingtech, which owns Dutch chipmaker Nexperia, plunged more than 10% in Shanghai after the Dutch government took control of its local unit. It's a sign that Europe is joining Washington in tightening its grip on strategic technology. The move also sent a chill across semiconductor names globally, reminding investors that geopolitics now moves the needle in the tech trade. Now, Tesla isn't the only EV company that's struggling with handle design. China's Xiaomi, which has staged an impressive rally this year, saw shares fall sharply in Asia trading after a tragic fatal crash. The driver of a Xiaomi SU7 electric sedan was locked inside the vehicle and bystanders weren't able to rescue him. The company didn't immediately comment. Moving on now, two big gainers you need to know about. BigBear.ai is climbing after confirming a new US Navy contract to expand the use of its artificial intelligence tools for fleet data analytics and mission planning. Applied Digital continues to attract attention for its data center build-outs, powering AI infrastructure for clients like CoreWeave. What stands out about Applied Digital is its resilience, even in a tough cycle. The stock rallied more than 16% on Friday, even amid a sell-off, and today it's continuing to skyrocket. Speaking of Friday's sell-off, let's take a closer look at how some key big tech stocks are rebounding this morning. Nvidia, Oracle, Qualcomm, TSMC, all in the green in pre-market ahead of the New York session. Even if there isn't yet clarity on what the latest back and forth between Trump and Beijing will mean for chips and trade relationships, Nvidia shares are almost back at $190. And New York listed shares of Taiwan's TSMC are up nearly 5% in the pre-market this morning. We'll keep watching these tickers and all the tech sector this week as earnings season gets in full swing and fears of an AI bubble mount. Well, Dan Ives, Managing Director of Wedbush Securities, shared his view with my colleague Julie Hyman.
Dan, it's great to see you as always. So we're going into earnings season for these companies at a time where there is this debate about valuations. There is this debate about the so-called circular economy, how much they're all sort of spending on each other. What are you going to zero in on in these earnings reports?
Yeah, Julie, I'd say, the street's still massively underestimating what this tech cycle is going to look like. I think it's an AI super cycle. And I think this 3Q earnings is going to be much more of a validation moment in terms of not just for chips, but for software. And I think the broader build out, look, the bears in hibernation mode, they've missed the last 2.5 years. And they'll continue to miss this bull market that I think has another 2 years ahead of it.
You know, it's interesting because I haven't talked to that many bears, right? The straight up bears are hard to find on this stuff. It's more the message that maybe you should start to diversify a little bit. It's not that you should sell necessarily, maybe take a little bit of profits and put it in some of the smaller companies in the space, put them outside of AI entirely, because maybe we're in a little bit of a breathing period here. What do you think of that argument, Dan?
Look, I get it. But my view is we're in the second inning of a 9-inning cycle. So, to peel away from an AI perspective, talk about people that peeled away from AMD over the last, a month ago, or Oracle 6 months ago, or NVIDIA a year ago. See, my whole point is the street's underestimating what this cycle is going to look like. And I think ultimately in the next 1-2 years, numbers are maybe 20-30% underestimated. And I think that's why 3Q earnings is just going to be more validation, showing the use cases are exploding.
At the same time, what do you make of the report from the information about Oracle's margins and that they are just not making money on this stuff, or that they're, that it is the current calculus of the return on investment is very low in some of these projects?
Yeah, I view that as kind of noise. To be honest with you, and anytime that sells off on articles like that, you just buy it, in terms of Oracle, because I think ultimately, as this plays out from the government perspective and from enterprise, look, for the first time in 30 years, the U.S. is ahead of China when it comes to tech because of this AI revolution. And I think we're going to look out. And I think how we talk about things like NASDAQ 25,000 and 30,000, the whole time, the bears or the valuation focused investors, they're going to miss this run, just like they've missed it the last few years, like they've missed it the last decade. I view this as sort of a fourth industrial revolution, and I think Street is continuing to massively underestimate what demand looks like.
In recent months, Bitcoin has often been called digital gold. The rise of the world's largest cryptocurrency has been powered by diversification as investors looked for alternatives to stocks. We've heard more and more people, from analysts to banking executives, calling Bitcoin a safe haven and a store of value, comparing it to gold. But today, the picture looks very different. Look at this chart. As Bitcoin and Ethereum suffered their worst day of the year on Friday, tumbling more than 12% at one point, gold kept rallying, climbing close to record highs. And yes, crypto is rebounding this morning, but the Friday crash tells us something fundamental. Crypto still trades like a highly volatile risk asset. It moves with equities and sentiment, not against them. When fear hit markets on Friday after Trump threatened new massive tariffs on China, money didn't flow into Bitcoin. There was a sell-off and investors flocked to the classic safe haven, gold. It's happened before. In June, for example, when tensions in the Middle East spiked, Bitcoin fell while bullion rose. Analysts say this latest sell-off exposes why digital assets can't yet claim the safe haven status. They're still highly volatile, speculative and sensitive to liquidity. And governments around the world still prefer gold reserves to reduce their dependence on the dollar. So for all the talk about digital gold, crypto's big swings are a reminder that the real refuge is still the 1,000-year-old metal that keeps glittering in the eyes of investors. Okay, and one last piece of news you may be interested in. Joel Mocker, Philip Aghion and Peter Howitt have won this year's Nobel Prize for Economics for their work on explaining innovation-driven economic growth. They'll be taking home over $1 million between them. Okay, let's have a very quick look at the markets before we go. Let's start with Asian markets. And just to remind you, a pretty bad day for Asia. All stocks there down pretty heavily. The Nikkei was actually closed today, but in China and Hang Seng were down pretty sharply, despite President Trump sort of backtracking on his statement earlier on Friday when he talked about 100% tariffs on China. And so Asian stocks took the hit today. They're obviously more exposed to trade tensions and obviously any relationship issues between China and the US. Okay, let's move on to Europe, and it's a completely different picture here. Apart from the FTSE, maybe a bit of profit taking there. The FTSE did hit a record high on Friday, but stocks in Europe were doing pretty well after that Trump social media post about sort of backtracking on what he had threatened against China. And let's have a very quick look at US markets as well. And it looks like it's going to be a pretty positive day after a pretty dramatic Friday where stocks fell heavily, but looking more positive today. Okay, that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.